Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Temur Beg, Chief Economist, welcoming you to our 167th episode. Now, this is a first. We are recording with someone in Hawaii. Noah Doyle, Managing Director at Javelin Investment Partners, is based in Northern California, but is kind enough to take time out of his Hawaii vacation to join us today. Noah has over 20 years of background in entrepreneurship and management of innovation. He has been a part of the genesis and growth phases of numerous consequential tech firms. We will discuss the world of investment in tech innovation with him today. Noah Doyle, a warm welcome to Kopi Time.
Thank you, Timer. It's great to be here.
It's super great to have you. I have a bunch of questions around the tech ecosystem, but first, a general one. Noah, what's the vibe in Silicon Valley as 2025 draws to an end?
Yeah, great topic to start with. It's definitely a vibe where it's hard to really put the enthusiasm level into words. You've had just incredible breakout growth across many different companies, and almost every high growth high tech startup has been impacted by the new AI tools that are available. They're using them to become more efficient, to grow faster, to innovate in ways that we're really just. It feels like we're in the early innings or at the tip of the iceberg of what's possible, and I think that enthusiasm, is just palpable in the tech world. And it really transcends almost every sector, from manufacturing to life science to the classic software and internet spaces. So I think that it's attracting a lot of mainstream attention, and a lot of investment. And I'm sure you're going to go there, but it's been hard to contain the enthusiasm level in some respects.
Give us a sense of this year's sort of the growth stories or the returns that people are looking at. I want to head into the direction of, are we in a bubble, but not yet. Just help us set the background a little bit about what sort of returns are people looking at? Are people actually getting exits? So you're in the VC world. Are you guys sort of satisfied with the deal flow that's taking place right now?
Yeah, that's a great question. So I think that, maybe to answer the first part of it, we are seeing rapidly escalating valuations for the leading companies. So on the heels of a valuation in the $60 billion range for Databricks, you had a series of fundraisers by OpenAI, most recently, in the $300 billion range, and then, I guess a rumor that they're doing it or looking to do a transaction at a step up from that, possibly $500 billion. Anthropic just completed a fundraise over $100 billion, and then did another quick follow-on transaction at the $130 billion range. So these are just really incredible numbers. Totally unprecedented, kinds of levels of valuations for private companies, especially to be escalating so quickly. But the revenue growth rates have been stupendous, and the companies are operating, with revenues in the billions of dollars, much faster than businesses have historically been able to achieve. So it does feel like there's it's hard to say what's justified or what isn't. It's a guessing game, of course, and investors are voting, with their wallets, but the votes just keep getting bigger and bigger tallies. So I think that's kind of the backdrop. But the other aspect of it is that each of these companies started with a small team of people and a few $1 million, and that's really what where the value is created in venture capital, is in identifying those teams and getting those early ownership stakes, and that's what Javelin is focused on. So we're really investing in what we call pre-traction, signal before traction is our motto, and we're looking for companies where there's an indication that there's enormous potential to achieve breakout growth, but it hasn't yet been demonstrated. So we're putting the pieces together to form a puzzle that ultimately, paints a picture of a company that can become very successful. And then we're getting a comparatively high ownership stake for a few millions of dollars, sub $10 million funding rounds, and we're usually leading it, taking the board seat, and working with the companies closely to get to that next level. But I think that whole arena still remains very vibrant. We're seeing more deal flow, higher quality deal flow, companies that have achieved more with less than ever before. And I think that's also, because that's in many ways the bread and butter of the venture capital industry, it's encouraging, and it's supporting the whole ecosystem. Yeah.
And how is this different from the past cycles that you've been involved in?
Yeah, that's a great question. I think in some cases, in some respects, you have more experienced founders. You have much better tools for them to build their products. You have better established paths to market to introduce them and start to generate revenue. You have a lot more of the kind of pieces needed to create a great business are more mature and better defined than they ever have been. And that's just enabling companies to grow faster, once they get established. We were investors in Niantic, the company that created Pokemon Go. And when they launched Pokemon Go, because of that mobile app ecosystem, they were able to achieve hundreds of millions of users in a matter of months. Something that just wasn't physically really possible, before that ecosystem was in place. So if companies are able to achieve that lightning in a bottle, then they really can grow faster. Then the new records are being set regularly in terms of how quickly can a company get to $100 million.
Right. I guess OpenAI really has sort of trailed in that area, or really been a trailblazer there, because I see Absolutely. All these charts. Yeah. If your former employer, Google, for example, the time it took them to reach scale versus how long it takes OpenAI to reach scale. We thought that was super fast, and now they're redefining what super fast is.
Yeah, the record, has been broken. Like the time to break it, it seems faster and faster each time around. That's definitely getting mainstream attention. So the public investing world is looking very closely at what's happening on the private side, and they're definitely knocking on the door. So it's I think it's no surprise that the dollar levels of investment in venture are starting to go up again, and you have a number of factors that have been challenging for venture in the past 3 years since the end of COVID, where during COVID, all digital businesses, right, all tech, expanded very rapidly. In the post-COVID environment, with the increase in interest rates and the reset of valuations and multiples in tech companies, a lot of the investment interest in venture capital waned, particularly because valuations had run up, but the distributions were behind because of the difficulty of going public. Today, a company needs to be a lot bigger than it used to be able to get public, and the slowdown in M&A with stricter antitrust enforcement, and really just I think as the large tech companies have gotten bigger and bigger, and they're looking for acquisitions that really move the needle for them, there are fewer and fewer of those companies that are also of comparable scale. So it's led to pullback from LPs in the sector in the past 3 years, and that's now getting kind of counteracted by a lot of new interest from newer investors who hadn't been in the venture capital sector before, who are coming in. So we're starting to see things turn in that regard.
Who are these new investors? Are they international, or are they U.S. or North America-based real money who were not into VC before?
It's mostly international, I would say. So actually, European investors historically had a relatively small percentage of assets allocated to alternative, and venture capital was the smallest of that allocation. So many large family office groups and multi-sector investment groups had limited to no venture capital exposure at all in Europe, and probably nothing in North America, even if they had some in Europe. So that's a very big pool of capital. And then definitely across Asia as well. In economies like India and Hong Kong, Singapore, you had a general preference toward more traditional investment style, cash flow centric, value based. Venture was always a little bit perceived as risky and out there, and I think a lot of those, especially the larger family offices that haven't had that exposure, are now getting very interested in it. So that's happening for sure. And you're also seeing established groups. You're seeing sovereign funds. You're seeing hedge funds crossover, from private to public, more so. So that's all driving it. I think if you look at the pace of fundraising, it's still below, where it was 3-4 years ago. But it's I think the signs that it will turn and it'll start to pick up again are there.
It's fascinating. On one hand, we don't have like the greatest ever capital market momentum. I read articles about private equity firms are lengthening their exit average duration. I just what you're saying, that you have a crop of investors coming in, but it's still not like an all-time record high in terms of deployment. But at the same time, when we read the headlines from the OpenAIs of the world and the kinds of investment they're doing, it's just absolutely jaw-dropping. So there is this whole ecosystem, Noah, it seems to me, of fundraising beyond the whole VC ecosystem, which is just the private credit world, private debt world, where the OpenAIs of the world are going and creating syndicates of banks and so on. So is that just a separate world from your world, or you guys also get to be part of that?
That's a good question. I think it's those are really direct investments in the companies, and I think the companies, as they get scale, they're able to tap much more established pools of capital. In many cases, public pools of capital, where you have big crossover investors like Fidelity, Wellington, Vanguard. They're actually trying to. They have a specific strategy to take stakes in tech companies that are likely to go public in order to start building a stake that then they would add to once they're public. For the companies themselves, those sources do open up. For the funds, it's a little bit of a different ball game because you're looking at LP commitments that get drawn down over the life of a fund. So you need institutions that have a capital planning cycle and have have a committed capital model, and it's a bit of a different marketplace. Venture capital, even though it gets a lot of attention, it's still relatively small in the scheme of things, compared to even growth equity or, certainly LBO, it's still like it's probably just 6-7%, of the total private equity universe.
Right. But a very critical part, because that's where the seeds are.
It becomes very influential. Yeah. When it works, it's very influential.
Indeed. Okay, Noah, the billion, or is it $1 trillion question? Are we in an AI bubble?
Well, it is a complicated question. It certainly feels like it on some days. And one of the things we've been in discussions with our investor base around this question, that they're getting a bit concerned about how capital's getting deployed, and how valuations are changing, and how to interpret all this. So we did a little bit of an analysis of venture capital deployments and what they are, what they're trending towards. And one of the developments of the past 6 months is that 64% of venture investment went into AI companies. Mm-hmm. In the first half of 2025, and I think that I'm just sharing this slide with you, and actually, is it this screen sharing is paused? Well, I can send this slide to you later. Maybe I'll just describe it for now.
Okay. It seems like I've got some firewall issue. So although you have the right to share, somehow it's not happening. Just read it out for us, Noah, and I'll make sure that our listeners and viewers get to. Oh no, here we go. I can see it.
Oh, there it goes. Okay. Yeah. Okay, great. I just selected on my side. Okay. So if you look at total investment dollars that were deployed in venture capital, there was a run rate in the late 2010s, right? So kind of 2015 to 2020, venture capital moved up from the historic range of the $30 to $40 billion level, and it stepped up to about $100 billion, give or take. Then post-COVID, there was a massive run up to $359 billion, total deployed. Yeah, and it's since then basically reverted to that $100 billion level. So you had in 2024, 2023, $165 billion, 2024, $215 billion. But in that 2023 period, the AI boom, really started, and a significant portion of those dollars were going to AI companies. And one of the unique aspects of this particular investment cycle is that these companies take enormous resources to build their products. So to build a state-of-the-art LLM today does require billions of dollars. It's probably a minimum of $1 billion to build a model that can compete at the top level, and arguably, could be more like $2 to $2.5 billion required. So the companies have been showing enormous growth, but they're also incredibly capital hungry, and a lot of the funding interest in the companies has also been coming from the hyperscalers, where the companies will receive investment from Google, Microsoft, NVIDIA then turn around and spend that money with them to actually build their models and do the training and utilize their compute capacity to create and serve their product. So it's created really an ecosystem that has concentrated a lot of investment in this AI sector. And if you take that 64% of investment in the first half of 2025 that went into AI companies, but you sub-segment it by the amount that went into very, very large rounds. So rounds of $250 million or more, which, historically, a $250 million round in venture capital was extremely rare. It would have been a pre-IPO type mezzanine round for a very late stage company. So if you sub-segment by larger than 250, less than 250, 89% of those AI dollars went into those large rounds, those kind of supersized rounds. And that's in a very small number of companies as well. So just about a dozen companies. If you look at what's remaining in the venture capital investment level, you still have a total deployment into general tech, excluding those bigger AI rounds, that's actually quite healthy. So it's still running at about $110 billion annually. And what that means is that the AI boom, so to speak, has not sucked the air out of the room for other high growth tech companies. Well, the entire ecosystem actually has been benefiting, and the investment levels are remaining pretty healthy across the board. So I think that although there's a concentration of investment in a small number of companies and the levels are unprecedented, it doesn't have that bubble characteristic of sucking all the air out of the room for everybody else. So that's kind of a healthy sign, I think. I think the other area of analysis around the bubble question is what percent of GDP, has the data center investment level gotten to? And although it's definitely, like, the numbers are really large, $344 billion, to be invested this year by the hyperscalers, in new data center buildouts, probably about over $400 billion projected for next year. It's still only about 5-6% of total capex, across the economy. It's about 1.2% of GDP. It's growing very rapidly, and that growth has aided, U.S. GDP growth. So probably, and for a variety of factors or reasons, GDP growth in the U.S. has been slowing. The rise of interest rates, biggest reason. So the belief is that the AI investment wave, or at least AI-driven investment wave in tech infrastructure, was responsible for about half of growth so far in 2025 in the U.S. But that said, it's still relatively small in the context of a very large, diversified economy. So it hasn't, the dependence or concentration of spending that has happened in past bubbles, where a particular sector got to be 5-10% of total GDP, and then overinvestment led to a retraction where it sank the entire economy. It doesn't look like we're anywhere near that kind of territory today. There is a lot of stock market concentration of value, in the Mag 7. I guess they crossed about 35%, or they're hovering right at like 35% today. They crossed over it, a few weeks ago and then gave a little back. So that's certainly a concern, that if the growth cycles, for the leaders in the high valued companies in the stock market, start to show signs of weakness, you could see a retraction in the market, and you could see some wealth retraction there, but I think it certainly hasn't happened. And these companies they're very, very profitable. They're trading at relatively low PE to growth rate ratios, and the fundamentals look pretty good. So I think it'd be easy to kind of try to call it a bubble. You probably get better headlines, by calling it a bubble.
Every day.
I'd say the underlying factors don't really point in that direction.
Maybe since we're talking about headlines, might as well talk about the two big headlines. So one is the circularity aspect, that the big ones are buying things of each other. And the second is the Mike Burry critique, which is that the high-end chips have very short period of obsolescence. And therefore, they need to sort of depreciate them much faster, and that would create certain accounting dislocations. Do you have any view on either of those issues?
Should I take the sharing off for now? I might come back to some of these other slides as we talk about them. I think so. To the second point about depreciation, so there are a couple of factors there that, yes, like it would seem on the surface that because these high performance GPUs, the chips that are used to drive AI data processing and, are being, purchased at incredible scale, and newer ones are coming out every year, or, if you count the delays, then a little bit more than a year, since the last generation. So maybe the timelines are extending a little bit for the generations. And the demand tends to shift, toward the latest ones. Although it takes time for the newest generation to get to production scale and get to delivery and deployment scale. What's the value of the last generation? It must be like zero. But actually, that's not the case, because you can virtualize the older chips and still deliver a very good service, and a pretty good performance level. You really need the latest generation only to do the kind of headline top ranked first tier model development, which is the newest, greatest models that are going to get the attention, or kind of leading the marketing push for Alphabet and Microsoft and Meta and OpenAI. Everybody's trying to showcase what they're doing at the leading edge, and certainly having the most performant chip set gives you the best chance at delivering something that's eye-opening, that really tops the benchmarks. However, each of these companies has many products, and a lot of those products don't require that latest generation to build or to serve to end users. So you can use the older products; they work just as well. They're less efficient, but they still work fine. And over time, you can add them to a pool of resources that gets virtualized, and you can still get pretty good value out of them. You charge less to the end customer, or you're using them for lower value use cases if it's an internal calculation, but they're still very useful. So I think there's a little bit of a misconception around what's that value change from the latest generation to the next. Some of the depreciation assumptions of 5 to 7 years, depending on the company, they're based on that expectation that the older generation will get shift to lower use cases, but will still have value. They actually have a lot of experience with that with CPUs. So it's really the same with the CPU. When you buy a new server, you put the latest gen CPU in it, and then you run it for a long time.
Right.
So, as you expand, you're expanding with the newest stuff. You generally are not really replacing older servers with the latest CPUs that frequently. So that, those assumptions aren't necessarily crazy. I think, they're rooted in some level of experience. The other thing is that the depreciation is just a book value factor, and the cash flows, all this is factored into the cash flows. So when you look at the EBITDA performance of the companies, those GAAP book value assumptions aren't are subtracted out. So the cash flows have been good for these businesses. So
Right.
they're in many cases they have customers on the hook waiting to pay for these services and make these big cash commitments, and contracting commitments. And that's really how it's being priced. So the book value issue, I don't think it's not like you're creating a a CDO, out of mortgages, right? Where you're, slicing and dicing it and making a zillion assumptions, and then it has to have value that's going to perform for 30 years. It's not like that at all. It's actually very like open book, very clear what the cash flows are, and these depreciation assumptions are I think they're relatively minor in the scheme of the valuations of the companies.
All right, very good and very useful. As long as I suppose the interoperability part and the backward compatibility part remains intact, you can certainly rely on your older chips for much longer than what Mike Burry is suggesting. What about that first point, the circularity aspect?
Well, yeah, I think the circularity aspect, it's been growing, which I think is a concern. It has not been that significant to date. In terms of driving the revenues for NVIDIA in particular, to some extent, the investments that Microsoft have made, Microsoft made in OpenAI, and that Alphabet made in Anthropic, and Amazon made in Anthropic, had circularity aspects to them that supported their cloud businesses. But those cloud businesses are so enormous today and have such huge diversified customer bases that the revenue impact to Alphabet and Amazon and Microsoft is really quite minor. It's maybe a few percent that gets recycled or circled back in spend. So it's really not it's not really that significant. It's also something that historically the hyperscalers were not the lead investors. So the rounds would come together, driven by financial investors, would get priced and mostly filled out, and then the strategics would come in and top it off, add some additional capital, and that's very much how NVIDIA's been treating these funding rounds. So they generally have not been the lead or the largest source of the capital. I think if that were to flip, and you were to start to see the hyperscalers be the primary source of the capital into the companies that then needed to turn around and spend it with them, then I think it would be reason for concern. But it hasn't been the case. So I think it's definitely an area to keep an eye on, and over time it could be a concern if it grows. But I don't think historically it's been a pattern. There's not really a pattern there that would indicate fragility or an over dependence on that circular funding for the ecosystem.
Noah, you and I began our careers under the shadow of the dot-com boom burst. One of the things that we saw there was that the original infrastructure companies that lay the pipes for internet, were not the big profitable ones. The one who build applications on top of that are the ones who really hit it out of the ballpark. I guess my question is trying to draw a parallel between then and now, which is, are LLMs becoming ubiquitous, or from your vantage point, you see sufficient differentiation that all the big ones that take billions of dollars to build out and scale can operate next to each other. It doesn't have to be winner take all or winner take, most.
Great, yeah, great question. I think yes, there's a very significant difference between dark fiber and LLMs in the sense that LLMs and really AI technology, more broadly, has just it's anywhere there's knowledge creation, knowledge management, knowledge manipulation, information manipulation. AI has an opportunity to make people more efficient, make businesses more efficient. So it's in some sense a much vaster market opportunity than just the opportunity to move bits around through a pipe. And yeah, the telecom industry vastly overestimated, what the demand would be. And there was certainly, a insane collapse, a drastic collapse, but there also wasn't as much opportunity for differentiation there. It turned out that connectivity, became a commodity, and as to some extent was predicted, and the opportunities to create value add, were never really realized. Despite everyone's, all the telecom players talked about value added services and really worked hard to do it, but in the end, it was really connectivity was a commodity. With AI, it's really the opposite because the ability to utilize these products in different contexts is variegating, very rapidly. You're seeing a number of products that are much better for code development. You're seeing areas of specialization around science and research and life science and physical world. You're seeing a set of companies, including the company that spun out of our investment in Niantic, when Niantic sold its gaming business to the PIF-backed company Scopely. They spun out the platform business that had enabled Pokemon Go to operate, called Niantic Spatial, and they're building a real world model that will enable visual GPS. So without a GPS sensor, you'll be able to point your phone anywhere you are and get an extremely precise geolocation, and be able to create real world experiences using highly detailed geospatial information, be it navigation or logistics or experiences like gaming. It's a AI enabled and AI powered set of capabilities that are moving into the physical world and have all these new use cases that just weren't possible before. So I think it's a very different kind of thing. It's something AI will already is and increasingly will impact everyone in their own life and career and how they live. And it's hard to really pinpoint the potential for value there, but it's really vast. It's much bigger than any one industry.
Excellent. Okay, I want to ask you something that you and I discussed while we were having a cup of coffee a few weeks ago in Singapore. Is the path to AGI through LLMs?
Yes, great question. It's increasingly hot topic as I think the biggest AI players are making big bets that LLMs are the path. And there's been I would describe it as an undercurrent of doubt, or at least suspicion that there's an alternate path. It's rooted in what has been described as the paradigm of neurosymbolic or symbolic AI intersecting with neuro-enabled AI, where neuro is the deep learning neural net-based LLM model that's very tech-centric, and the kind of fundamental, since the real, that technology really broke out and has shown enormous promise, many of the researchers and the engineers driving it have come to believe that if you throw enough data at these deep learning neural networks, they can start to teach themselves, and eventually you'll kind of recreate knowledge, or they will be able to recreate knowledge, on their own independently. And it's really a matter of getting to the scale needed to be able to enable them to start to mimic the human brain. And it's a little bit of a belief, nobody really knows if that's possible. It looked like there were some signs that these systems were like teaching themselves to do math and things like that. Those have not really played out, actually. And I think this undercurrent of different perspective around the intersection of symbolic AI techniques with the neuro side has shown a lot more promise. We recently made an investment in a stealth company that's focused on this particular area, and they have developed some early proof points of using logical reasoning and true understanding of language and the logical relationships inside language to show 10x speed-ups in processing time and training time for AI models, and show the ability to solve problems that have stumped the LLMs to date. So we really, on the investment side, see it as a huge opportunity. But I think in a broader sense, if you think about it at the philosophical level, if there's all this, established knowledge, we have mathematics, we have physics, we have logic, we have we have very structured ways of thinking about things. We have economics. Well, maybe economics is harder, but so there's a lot, still the dismal science. But there are a lot of arenas where there's genuine knowledge that has deterministic relationships. And do we really need to take computers through the process of teaching themselves all this knowledge without benefiting from it? Shouldn't they be benefiting from it? And in that case, can you, ingest the textbook, ingest the mathematics, and then apply it when it's relevant, and not need to play the guessing game, of a massive statistical probabilistic, extremely large model.
So on one hand, you're talking about the promise of thinking through not the neural network type architecture that these LLMs try to sort of foundationally build. And the very last thing that you said, which is, I suppose, the essence of an LLM, that it is a probabilistic model having ingested all the words and all the images that it can and trying to organize them. So your key point is that there might be a limitation to intelligent development out of that LLM framework.
Well, I think we're already seeing that. The scale of training, that these models are taken through has been increasing dramatically, but they're just inching forward on the benchmarks, by a percent or two, and they're still performing very poorly at some very basic tests, which frankly a 5-year-old can pass. So there's something missing, and no one, of course, knows what that is, or we wouldn't be here speculating about it. But I think there are quite a few certainly researchers out there who come from the symbolic tradition, or starting to look out at some of the techniques used in more traditional machine learning and expert system style, rules-based, logic-driven AI systems, AI techniques, and saying, how do we incorporate that into these models to make them smarter, make them more efficient, enable them to solve problems, truly solve problems, as opposed to just guess at the answers. And I think that's a very promising area. And I think it's broadly, it's good for society because it means that we won't necessarily need 10% of our energy devoted to AI, processing, training, or inference, right? In the future, there'll be more efficient ways of doing things, of getting to answers, and we'll be able to solve the hallucination problem, with systems that are more deterministic in nature, where there's a question that really has an answer. The product should be delivering the answer. Shouldn't be
Right.
shouldn't be playing the guessing game and getting it wrong.
Right. Absolutely fascinating. I'm sure listeners will start looking up the alternatives to LLMs that you're talking about. Noah, we have managed to have this detailed discussion without mentioning the word China once. I was looking at some trade publication the other day after the Gemini 3 model came out, and I was looking at the ranking of the top LLMs in the world. And of course, now Gemini 3 gets ranked number 1, and then a bunch of OpenAI stuff comes in. But when I look at the top 20, Noah, I'm just going to read you some model. I had actually never heard of these things. Number 5 in the world is Kimi K2, which is a Chinese company called Moonshot AI. In the top 10 ranking, I also saw something called Minimax, also from China. And this is not even including the DeepSeeks of the world and the LLMs that are the Alibabas and ByteDance is developing. So tell me a little bit about your perspective on the China tech stack. It's like 2 questions. One is your assessment of what they're doing. Are they doing it cheaper, better, or is it a whole new paradigm? And the second is, are we really heading into a world where we have 2 different tech stacks, made in China and made in the US?
Yeah, great question, and it's relevant for everyone in this field. My broader point of view on this question is that we're probably not headed toward 2 different tech stacks, because I think that the Chinese really can't take a risk of falling behind, and I think that they need to, for the most part, follow practices and use the infrastructure and use the tools, which run best on the hardware, that comes from the mainstream companies, and from the top models, And I think they've done that really, really well, and have demonstrated that they can be very scrappy, and they can find efficiencies, and they can do great work and make, real contributions, to the space. There are many of those Chinese researchers, based in China, were trained in the U.S., and it's actually, if you look at the field globally, it's a very international, field in terms of who's doing the work, and who's doing the development. So I don't really see it bifurcating, at least in the near term, especially while there is such a fast pace of development and so many innovations happening so quickly. No one can really afford to take a chance, on a secondary, or a different attempt at creating a tool set that just may not be as good. I do think that China, and the Chinese tech, community was, without question, always going to be very important in the AI world and AI industry. There was, and they've demonstrated that they can stay very, very close to the leading edge. And as you point out, actually, of late, develop very competitive models that are very low cost to run. So a lot of, especially consumer products, that are trying to service large numbers of users inexpensively are dependent on the Chinese models, and they're working really well. So I think it's a good thing to keep people, keep competition high. It keeps everybody honest. It keeps driving the industry forward. And I think it's the sort of questions for strategic implications. At least today, in the LLM space, they're not really that significant. I think there's sort of many people draw a line between having the world's best LLM and AGI and that ability to, develop some sort of, advancement on the strategic side. But other than maybe, cybersecurity, where, espionage or, a sort of disinformation, kind of stratagem, could be impactful at the strategic scale. You don't really have a direct relationship between the LLMs and strategic competition. It's much more really market competition as things stand today.
Okay, I'm glad you touched upon the cybersecurity issue. The additional strategic question that I had was ethics of AI. We basically went through 15 years of social media revolution without effectively putting guardrails around social media, and the cost has been the mental health of our youth. And today, I'm now beginning to see more and more articles, particularly related to Meta and its llama models, that a small but not a insignificant portion of, again, young adults exposed to these LLMs tend to have certain delusional experiences and so on. Actually, not just the youth. I've seen stories about the much more mature ones as well. So the Trump administration is very light touch on crypto, on AI, on everything. They want 1,000 innovations to bloom. Is that a risk that we are going a bit on the other extreme, bit of a wild, wild west, if you will?
I think there is a risk, and it is an oft repeated argument that any technology has its good and bad sides and can be abused, and the onus is on the creators, providers of the technology, obviously the users on their own recognizance, but and also society to react to that and to try to put safeguards in place. I think the likelihood for government regulation is probably not realistic for the foreseeable future. Not only because of the dynamics of the current administration in the U.S., but also the rise of the sovereign push for culture-specific, nation-specific investments in AI and in LLMs in particular, because of the natural language, intersection with culture and identity. These particular products really, every nation, feels like they need their own, is the end result of it. And I think that's happening today, but it's going to happen even more so in the next 10 years, where, every language, every ethnic group, certainly every nation is going to have their own AI models and their own, investment in creating training data sets and corpuses of information, to build from. So all of that means that you can't really have any kind of controls. Like, no one country will be willing to put controls on its industry or its development, right? If everyone else is pushing, as hard as they can, as fast as they can. So I think the dynamic, at least for the foreseeable future, and that's probably, something like a decade, is that there's going to be really minimal regulatory controls coming in over the top. Now, I think each companies, certainly the leading companies that provide these models that are very powerful, they are feeling a lot of heat around instituting controls. Anthropic just published a very detailed report on how their product was used in a cybersecurity incident. What they believe to be a state-sponsored entity used Claude to basically write code on the fly to hack into a system and or a set of systems and steal information. And it was very effective. They evaded the controls that Claude has to try to prevent that use case. And OpenAI since, or rather, Anthropic has since tried to strengthen those and improve upon those. And to their credit, they were very open about this and published it. And it's important because any provider of an LLM now needs to, really think about how to do the same thing and how to institute the same controls. But I think for now, at least, the onus is really going to be on the private sector to try to prevent abuse, and hopefully head off government regulation. If they do a good job.
No, I remember Skynet. Okay.
Oh yeah.
Okay, tell us from your vantage point. You look at lots of potential investor pitches on a regular basis. Few really promising tech that you see in the pipeline. Get us excited about the future, other than just the LLM stuff, Noah.
Yeah, absolutely. I mentioned Niantic Spatial. So we're very excited about the real world model that they're building and what that can accomplish. We also invested in the symbolic company that I mentioned, and we're very excited about how that could be potentially a new paradigm for general purpose AI systems. We're also big believers in small models and vertical uses of AI. We recently backed a company called Fuse AI that has created a marketing automation solution that allows a small to medium-sized business to execute an end-to-end process using AI and smart agents to identify customers, initiate outreach to them, engage with them, and then track their progress. So it replaces 5 common systems used for the sales management cycle, from the CRM, from data gathering to the CRM, to the email outreach, to the sales process oversight. And we're very excited about that. It's a great ROI, and it also really brings the benefit of AI to a smaller customer set that can use it in a turnkey way. We also have backed a text-to-speech company called Resemble AI, which just released a open source version of their platform, which has really taken off. And we're seeing a lot of that benefit of open source ecosystem development that enables developers to test and try something and get familiar with it and then adopt it, to be really important in this world. Resemble also took their experience in enabling voice AI to be, so much more useful, and has essentially applied the inverse of it to create a deepfake detection platform, which is a cybersecurity tool, which they now market on an enterprise B2B basis, and recently raised a round of funding with some great investors to take that to market. So we're very excited about Resemble AI as well.
All right, that sounds really, really good. Actually, I'm really glad that we're ending on a optimistic note. Noah, thank you so much for your time and insights, and thank you again for taking the time out of your holiday for us.
Absolutely, it's my pleasure. Great to be with you.
Great to be with you. Thanks to our listeners as well. This podcast was produced by Ken Delbridge at Spy Studios. Valetly and Daisy Sharma provided additional assistance. Kopi Time is for information only and does not constitute any investment advice. All 167 episodes of the series are available on YouTube and on all major platforms, including Apple and Spotify. For our research content and webinars, you can find them all by Googling DBS Research Library. Have a great day.